All right, good morning, everyone. Today we're going to talk about stocks. This quote up here I like is in this business, if you're good, you're right 6 out of 10 times. You're never going to be right 9 times out of 10. So investing involves risk. We're going to talk about the types of risk in this lecture. We're going to talk specifically about common stock, the most widely held stock asset. And then we're going to talk about maybe how you would pick a good stock, right? How you look at a company and say, all right, this is a good stock. But the idea that you're going to be right more than half the time and not right all the time. Right? It's not a perfect science, but we're going to talk about how you might do some stock investing. So before we get there, let's look at a difference between bonds and stocks, because bonds are going to be talked about later in this chapter, but it helps to be able to compare them early. Bonds are liabilities of the issuer. So if you're the company and you sell bonds, they're a liability, like a loan, right? So you have borrowed from some person, the bondholder, and you are going to pay them much like you would pay interest on a loan. You're going to pay the bondholder interest payments. These are typically done every 6 months. Stock differs, however, because stockholders aren't lending to the company per se. They are taking a piece of the firm for themselves. They own part of the firm, and so with that ownership, they have a claim to the earnings of the firm. But these returns are not guaranteed, right? Because the firm could have a bad year. They could not make profits. And so if the stock price falls because the firm's not very valuable, that the owner loses, the stockholder loses. They also might get compensated through what we call dividend payments. As the company makes money, they can pay these to stockholders over time, but also not guaranteed. If the company didn't make profits, they can't pay dividends. So let's see why both are useful investment tools here with a little video from Investopedia.
As you look to build your portfolio, you will find that you have a large number of investment options. The two biggest components of most portfolios are stocks and bonds. So how should you use them? One decision to make concerns your goals for your portfolio. Do you want your portfolio to provide a steady income stream, or are you looking for long-term growth? Stocks generally produce the best growth over time. A careful selection of stocks, including both large and small companies from a diverse group of industries, can produce excellent growth over time. For income, bonds are probably the better choice. Bonds pay interest twice a year, and the amount usually never changes over the life of the bond. Investors can buy bonds issued by local or national governments, as well as by major corporations. Even if you're sure of your goals, there's always room for both stocks and bonds in every portfolio. For more aggressive investors who want growth, bonds can help balance the risk of stocks and stabilize the ups and downs of the market. For more risk-averse investors who choose an income-oriented portfolio of bonds, stocks can provide valuable inflation protection. The amount of interest that a bond pays is usually fixed, so an increase in inflation can reduce the value of those payments. Stocks will help you protect your money from inflation because stock values often rise faster than inflation. Your stock purchases provide an opportunity for high reward and help to hedge against inflation, while bonds will provide a dependable safety net against stock market losses. A mixture of stocks and bonds can help investors to maximize profits and minimize risks.
Cool. So there's room for both, and the video illustrates that using both stocks and bonds can help reduce the risk you face when trying to make earnings from investments. So that's what we're going to explore going forward. Holding any one type of security is risky. And so what we mean by risk is this graph is showing us what a $10,000 investment at the beginning of 2006 would look like by the end of 2015 into 2016. And so if you had to guess the green line versus the blue line, which one do you think would be stocks and which one do you think would be bonds? Right? Earnings are not guaranteed with a stock, and they're going to fluctuate much more wildly than bonds, who have that fixed guaranteed income stream, those coupon payments. And so we're going to talk about this several times as I go through about why bonds are less risky than stocks. But the point that we're trying to make on this graph is you would be doing better holding a stock in this portion, in this economy, because the stock is outperforming the bond. And yeah, so to be clear, these are Vanguard mutual funds, and the green one, VTSMX, this is their stock market index fund. So it's just meant to track the stock market. So your earnings are whatever the stock market is doing, whatever like the Dow Jones is doing. And then the VWESX is a bond fund. So it's meant for long-term growth. And you can see the bond doesn't vary that much. The stocks vary quite a bit in terms of the value of that $10,000 over time, sometimes outperforming year to year. In this case, we got 5.49% return from the stocks, but only 3.75 from the bonds. So sometimes the stock did better in a year. Sometimes it did much, much worse. However, one thing you want to note is in long-term investment, you're going to get some fluctuations, but you always usually end up above where you started your investment. So it's best not to invest in a single one of these things, but to have a portfolio of securities. So why is diversification important? Well, there are different types of risks that you face when making an investment, and diversification can do a great deal to get rid of some of those risks. The systematic risk is market risk. This is market-wide risk that affects every single stock at every single company at once. So you can think of this as like economic cycles, like recessions. When the economy goes into recession, companies do poorly, and so the stock market dips. That's a market-wide risk. Unsystematic risks, however, affect certain industries or certain firms themselves. And so if one firm goes under, all the other firms can be fine because they're separate. They're not systematically related. The first type of this is business risk. This is the risk that you face when you become an owner of a firm by buying stock, that the firm might make losses or they might shut down. And so you might just lose your money because that firm goes away. Financial risk has to do with the amount of debt a firm takes on. So we talked about bonds being like liabilities. Well, one reason you might have a financial risk if a firm takes on too much debt is the firm has to pay their debt holders first before they pay anything to the stockholders in most cases. There's different classes of debt, but we won't go into that. But basically, if the firm were to go under or if the firm were to fail and they sold off all of their assets and began paying people back, they're going to pay the bondholders first and not the stockholders. So you need to think about how much debt a firm has. How leveraged are they? Purchasing power risk has to do with inflation. As the price of goods in the economy go up, the money you make can buy less. Right? Does that make sense? If I bought a Diet Coke at a gas station today, and it was $2. I remember like 10 years ago, they were 99 cents for the same size bottle. And so if I make $10 an hour, back 10 years ago, I could have bought 10 Cokes. Now I can only buy 5, right? So as prices go up, real income falls. This, once again, disproportionately impacts the two types of assets. If you have a bond that pays you fixed income versus stocks that change with the price level, which one do you think you would want to kind of hedge against inflation? Well, the video talked about this. Stocks tend to grow at a rate faster than inflation. As price level goes up, stocks are growing. That makes them more valuable to hold when we have inflation. At the same time, most bond interest payments don't change with inflation, so you're just getting poorer as prices go up. So you want to think about the risk of prices going up. If you're too bond heavy, you're going to be harmed by inflation. Interest rate risk is just like it sounds. You lock into a certain interest rate on your bonds. We looked at, for example, treasury bonds, but corporations can sell bonds too. and you have maybe, I don't know, a 2% return, and interest rates begin climbing in the economy, and you're going to be locked into a long-term asset with a poor interest rate. Can't get out of it very easily. Liquidity risk, it has to do with the frequency that you can trade a stock. And so a stock isn't very liquid if it's hard to find a buyer. We call those thin markets, right? It's one thing to want to sell the stock, but you have to have somebody who wants to buy it. And so if there's no buyer, you can't sell it, and you'll get stuck with a bad stock. These risks here are the ones that can be diversified away by holding stocks and bonds and stocks from different companies. We can diversify away a lot of risk. If we put all of our money, let's say, in retail, and then retail's doing really weak, we could lose a lot of money. But if we spread our investments across retail stock and agricultural stock and raw materials, if one of those industries goes down, it's not likely that all the other ones are going to go down as well. And so we can diversify away, for example, some business risk. Holding stocks and bonds help us to get protection against interest rate risk and purchasing power risk. And so diversification is going to be a very neat thing that we're going to learn. In terms of setting your goal, right? We did this kind of in chapter 11. We thought about, okay, what interest rate do I need to reach my goal? Well, if you're going to take on risk, you're going to want to have a higher interest rate. And so you'll notice that we assign this U.S. Treasury bill as kind of our benchmark for what we call the risk-free rate of interest. You're guaranteed to get money back with U.S. Treasury bills. They're the very safe investment. So whatever the return is on them at the time is the zero risk return. Anytime you accept something that has a little bit more risk, you should expect a higher return. So why do you think long-term bonds are more risky than short-term bonds? Well, long-term bonds are going to have higher interest rate risk, right? If you're locked into a rate for 10 to 20 years, it's probably going to be the case that interest rates in the economy are going to change. Whereas if you were in a short-term bond, you could get out of it early and get into something with a better interest rate, right? Real estate, going to have that high liquidity risk, hard to sell it off really quickly sometimes. So you want higher returns for taking on risk. Where do you get your returns from an investment? Two places. Capital gains, that is an appreciation in the price of the asset. So you think about a stock price going up, that's called a capital gain. Or current income. For stocks, this is dividends. Periodically, and most often quarterly, companies will pay payments to their stockholders in cash. On bonds, you get interest payments, and these are usually every 6 months. And so these are actually current income that happen each year. So when we're thinking about what return is acceptable to us, okay, I'm going to take on some risk. I want to have a high return. How do I figure out what that might be, given that I don't know what the future looks like? Well, we can compute some expectations. And so this formula is for the expected yield of an asset. And what we do here to get the expected yield over any number of years, 5 years, let's say, we'll take the average annual income payment. So over those 5 years, what did I on average get paid in current income, either dividends or interest from my bonds? Then that's the current income part, right? Remember, just up one slide right here. Then we take the capital gains. We take the price today minus the price when we bought it. That is how much the stock has grown or the asset is appreciated. And we divide by the number of years to get an average change in value each year. Because we're trying to get an annual rate of return, right? What am I going to expect each year? So let's get an average increase in the stock by dividing by the number of years. We're going to divide this whole thing by the average price of the asset over that time frame. So this is like how much income is being generated for my investment in the stock. So I have a question here. Why is it better to consider average annual income, average annual capital gain, and average stock price instead of maybe just looking at the most recent year's yield? right? Just look at what the return was last year. Well, what you should be thinking about is that last year could be an anomaly, right? We could have had like one really good year last year, but over a longer time period, the company has actually a very different yield. And so if we're thinking about just looking at rate of return, we probably want to do something over a greater number of years. So, for example, if we want to look at McDonald's, what I've done is I've gone to Yahoo Finance and I've pulled down McDonald's stock history for 1 year back. And we see here on June 1st, 2016, the stock closed at 120.34. And then just on May 19th, it closed at 148.15. So what we would do is figure out over this year, what was the average annual income? Well, 89 cents, 89 cents, 94, and 94. That's $3.66. And this is only for 1 year, so the average is going to be $3.66. So we would add that right here, 366. Now let's do the capital gains. Started out at 120.34 and it finished at 148.15. So that is a difference of about $28. And so we would divide that by the number of years, but we only have 1 year here. So over 1 year, the stock grew by $28 and we got $3.66 in current income. I'm going to divide that by the average of the price over the time period here. And so that is 148, 120. Let me get to my data here. 148, 120, the midpoint between those two. And so what we get is if you did this, if you want to do this on your own, I'm about to say the answer, so pause the video. But we get 0.2344. So 23% annual yield over this time period. That's pretty good. That's a pretty big yield. So now that we know how to think about the return we might expect on stocks and bonds, what are stocks, right? What's actually going on? Well, we're going to think about common stocks that are publicly traded on stock exchanges. And so what you get when you buy a share of common stock is a share of the earnings of the company. And I put this here again only after the debt obligations have been met. So you'll look over here and this is our income statement for the I guess a Sprint. And so we see that they brought in this 26,197 in millions and ended up with a net income of 1215. And so they're able to apply that to common stock, right? And so so this profit here is the owners they're entitled to it based on how much stock they own. And if you'll notice, where is it? In this section, we have the interest expense, the early retirement of debt, right? Paying debt holders first before we pay out to our stockholders, pay them dividends or decide what to do with our earnings. Common stockholders also get voting rights. And so what this means is they get to participate in the decision-making of the firm. How this works in practice is actually very interesting. So the SEC requires each company that's publicly traded to send out these Schedule 14As to their common stockholders. And what they are definitive proxy statements, and they let the stockholder know all the decisions that are going to be voted on. And so here's a note to the shareholders from the chairman of the board. Here's a notice of what's going on. We're going to elect board directors. We're going to approve executive compensation, a briefing on all of the things that are going to be talked about at this meeting. But small stockholders often cannot attend these meetings to vote in person. And why would they, especially in the digital age? So what happens with these proxy statements is down here at the bottom, shareholders get the opportunity to send their vote in. Well, this is longer than I thought. Here we go. Here's their ticket if they were to go to get admitted into the meeting. But if they can't go, here's their proxy card. They can cast their votes from abroad. And most of these are done online nowadays. But these shareholders get to decide, the new board members, they get to decide on executive compensation, etc. And of course, you get earnings, dividends, and capital gains. So dividends are paid quarterly. We saw with McDonald's, one payment each quarter, and capital gains are price appreciation. So we saw over here McDonald's price of the stock went up from 120 to 148. So we had capital gains and current income there. These gains are taxed, taxed in the year they're received. So your stocks can grow and never be taxed until you sell them. Once you sell them at a gain, that's when you pay the tax. Dividends are taxed in the year that they're received. Okay. In addition to looking at the expected yield of a stock over time, a common stock over time, if the stock pays dividends, we might also look at the dividend yield. Dividend yield is very simple. It's the annual dividend received. In our case, it was 366 over the stock price, which was 148. And it is just a way to measure and compare firms across industry based on paying dividends. If you care about receiving income from stock, you want to pick between companies that have high dividend yields. Okay, we're going to take a break. When we come back, we're going to talk about ratio analysis.